The big focus for the day is likely to be on the start to Fed Chair Powell's semi-annual congressional testimony. Today, the Fed Chair will testify before the Senate Banking Committee, and there will be a lot to talk about after the Fed just went ahead with its biggest rate hike since 1994. The big challenge for the Fed right now is how it plans on attacking inflation, or perhaps more precisely, exactly how far the Fed is willing to go to address rocketing inflation at the expense of the economy. The more we see aggressive rate hikes, the greater the chances for a recession at some point in the months ahead. We know there is not much choice when it comes to needing to normalize policy, but at what point do higher rates become too much for the economy to bear? The Fed is between a rock and a hard place, and this is only going to get that much tougher as we move forward. Right now, things aren't even so bad, as there is broad consensus that rates do indeed need to go higher, but we could soon start to see questions around just how far the Fed plans to go if the economy is screaming out for rate hikes to slow down. These questions could surface during today's testimony, and the Fed chair will need to be careful how he navigates through all of this. Perhaps the most worrying thing for markets right now is that the Fed declared its commitment to restoring price stability was unconditional. If the Fed truly backs this up, the outlook for financial markets could get even uglier. At the same time, Fed credibility and forward guidance haven't exactly been all that reliable in recent years, and we suspect the Fed could deviate from this unconditional language if there is any evidence of higher rates having even the slightest of an impact on inflation. Remember, it wasn't too long ago that the Fed was saying that inflation was transitory before it abandoned that language. On net, the more hawkish the Fed chair sounds today and the more committed he is to this unconditional language, the greater the risk of additional fallout in stocks and a rally in the US dollar. If, on the other hand, there is a sense of a willingness to be more flexible with rate hikes on any sign of inflation coming off, investors could celebrate this line of speak and stocks could turn back up with the US dollar reversing lower. But we feel at this point the greater risk is for more of the same hawkish communication that weighs on sentiment. That's all for now.